Yeah, so the recording is on. So obviously anyone asking questions need to understand that, yeah, those questions will be part of the recording and obviously our answers as well. So please feel free to ask questions as we go along, and then there'll be a time at the end also for asking questions. So I'm going to bring up the presentation. So this is a follow-on from a webinar we did, I think, 2 or 3 weeks ago, giving like an overview of commercial property investments and a little bit about the type of things that we tend to focus on. There's a lot of slides in this presentation because we'll be able to make the presentation available to people who want it. Some of them are similar slides from the previous presentation, and we'll just be going over those quite fast. So if people want like more in depth on that, feel free to ask for the copy of the previous presentation and recordings. So for those of you who don't know myself and Duncan, we're going to introduce ourselves. So Duncan, if you'd like to introduce yourself,
There you go, that's
you've
me.
got 2 minutes for that. And I'll take 1 minute for introducing myself afterwards.
No pressure. So good evening, everyone. Duncan Knight here. I'm formerly a commercial chartered surveyor, and I spent my sort of decades worth of experience mostly on the advisory side, but more recently client side as an in-house asset manager for sort of a high net worth in London. And about just over 12 months ago, left that to start my own consultancy and investment management business. So yeah, that's what leads me as to why we're here today, really.
And
How's that,
then,
Trevor?
so
Quick enough?
yeah, that's good, Duncan. Thanks. Yes. Yeah, we're going to keep it short, so have as much time as questions and specifically to go into details of how some specific investments work. So this is myself. I'm originally from an IT background, and around 7 or 8 years ago, started buying the standard buy-to-let properties, operating them as HMOs and serviced accommodation, and then got into like mixed use commercial properties. I'm doing some education and trainings, some mentorships for some people, and have obviously always had an interest in pure commercial, but it does require experience, and teamed up with Duncan, where we're looking at some projects ourselves, obviously also inviting investors to come on board with us, and yeah, giving advice and basically, yeah, allowing people to understand how commercial property investments can work. And we've got a slide at the very end on, obviously, this is going to be a really fast one on SSAS and how SSAS, as we all know, can invest directly in commercial property. So it's something that's really important to understand. So I'll do the fast introduction, and then at some point we'll listen to Duncan rather than myself. So commercial property in the UK can give solid returns to investors. And the same as in residential, we're looking at ongoing income and capital appreciation. And in exactly the same way as a lot of you are probably familiar in residential with buy, renovate, rent out and refinance model in order to be able to get most of the deposit money out and recycle it to get on to the next one. We can do the same thing or similar things in commercial property. Generally, the time frame's a little bit longer and the amounts are larger. So instead of dealing with 5, let's say, buy-to-let properties in some not exactly remote area of the UK, we're dealing with maybe one single commercial property to get the same financial results. And yeah, we mentioned that SSAS can invest in commercial property. There are different types of commercial property. Some obviously have higher risk than others. I'm going to let Duncan present this one. in 1 or 2 minutes, and to explain maybe why some things are considered higher risk, because this will lead on to the type of property that we are ourselves particularly interested in and the reasons for that.
Yeah, thank you. So I think generally these these asset classes are subject to a lot of sentiment and a lot of sort of consumer behavior. So at the moment, you'll generally hear that sort of retail is going through a bit of a tough time, as with offices, but predominantly more sort of regional offices, where the yields are higher to reflect the risk and the relatively insecure income profile. Industrial has performed very, very well over the last couple of years, primarily through e-commerce, but also changing sort of consumer habits, and more so to reflect the fact that industrial has, for a long time, up until the last sort of 5 to 10 years, has actually stayed very low. So it's come from a very low sort of base in terms of rents and values, and is now shot up and sort of catching up, really. So we've seen a big boom in industrial values and rents as well, which has led to a lot of piling in from sort of the larger investors, pension funds, sort of sovereign wealth funds. So that sort of generally gives you a bit of an explanation as to these asset classes, but there are opportunities within every asset class. Leisure hotels obviously suffered a lot through COVID, but have actually in the UK remained relatively stable over the last year or two. Particularly hotels has been quite sort of a hot topic for a lot of investors at the moment. So yeah, hopefully that gives you a bit of an overview.
Yeah, and I just add, like we've got at the bottom of here, all of these obviously different risks, different specialist knowledge required in each of them. For example, operating hotels completely different from dealing with offices. And generally, obviously, we're focusing on a specific type of asset. Some people might be interested, maybe for some background, may have interest in hotels or leisure, but it's always recommended to focus on one particular type of commercial property asset, understand how that works, rather than trying to have a finger in all sorts of different pies.
But ultimately, right, but the extra cash out of the deal, 186. But here's the thing, if you title split them, if the commercial val was better, go for it. Take the commercial val, 5 years later, remortgage onto buy-to-lets if that's better. That's how I roll. So
sorry, could you ask that question again, please? It's not a very clear line.
By the way, if you wanted all your money out, and I don't need to miss this, just sell one flat. And then there's not 43 grand left in, you've got all your money out. And you've got 6 flats, cash flowing, cost you £0, don't you? That's called a MIMO, money in, money out. So let's focus on splitting leasehold and freehold across unsplit apartment blocks, commercial properties, commercial to residential, and land split.
Yeah.
Okay.
Can I stop you for a moment? It's a bit difficult to.
Here, who is now going to tell you how Searchland is going to.
Yeah,
I think
yeah, sorry, not able to hear that. We'll continue the presentation. Maybe if you've got a question, maybe you could actually write it on the chat. We'll see that at the end. So we're going to go on straight away to the type of assets that we're focusing on and the reason for that, and the risk profile. So I'm going to actually hand back to Duncan to go over this part of what we're looking at. There is a case study in there which we presented last time, which is a property that Duncan purchased just over a year ago. He'll talk about that for 20 seconds because we've already spoke about that, but it's on the slides if anyone wants to have a look at it.
There you go, fast fire. So generally, the aim of our game at the moment is to hunt for multi-let properties, which typically reduces the risk, it spreads the risk. It allows us to draw on multiple sources of income rather than just one sole income source. So we're looking for big enough buildings to cater to, 2 or 3 plus occupiers. The opportunities that were presented to site are 2 office buildings, but we are covering industrial, and we do actually look at retail as well at the moment. So if there are any bespoke requirements out there, then we can happily talk to you about those offline separately. But generally, we're at the moment, the 2 opportunities we're about to present are between 600 and $1 million in terms of value, but we're looking at, both of them are multi-let, some with part income and the other with full income at the moment. So those are the sort of rough yields you can see, typically 8% or higher. Generally, these 2 are 10 to 12% at the moment, to reflect some level of risk, but also the asset management opportunities that we believe we can capture. I think that's mostly it on that page, Trevor.
Yeah. Can I just maybe add 1 or 2 things as we're speaking? The aim of generally what we're looking for, and the focus, is specifically to find properties that are already income producing, but have got almost immediate or really short-term potential to increase the income. And there's different ways of increasing the income. One can be occupancy, adjusting rents to market value, renegotiating leases, sometimes doing some small capital expenditure improvements, but nothing significant. And then there are sometimes possibilities, if we've got multiple units, we can sometimes sell some of them off on long leases and do development of what's existing building, or if there's land where we can build additional things. So it really is, it's not just a question of buying an asset that's income producing, like buying a buy-to-let property and forgetting about it and expecting just to have that continuously yield. It's really a case of identifying properties where we can get them at, obviously low value, and with the aim of refinancing. We're not going to go into a lot of detail about commercial finance and how commercial finance works, but in a nutshell, we know this is based on the income and the commercial yields. So by increasing the income, increasing the quality of the tenants enables us to significantly increase the values in order to, exactly the same as any type of property, to refinance and to get the money out that we put in originally. So yeah, Duncan, I'll maybe let you continue with this one.
So generally, we're looking at asset management opportunities here. As Trevor has just explained, we are looking beyond the day 1 return and thinking, hang on a minute, how do we really maximize the value of this site so that we can look to refinance, within the short to medium term, depending on the factors and what the strategy is. I think here, Trevor, we're talking about sourced and investments and joint ventures. Do you want to just briefly cover that?
Let's get on to. So this is a case study that we're not talking about. Just tell us, Duncan, in 20 seconds, the return on investment and money out on this one.
Do you want to flick over the next slide? I think the numbers are there. But essentially bought this building back in May last year. We bought it at a 10% yield, bought it for 650,000, and it was bringing in 65,000 on day 1. And over the last year, we've worked very hard to increase the income from 65 up to 86,000 a year, which we won't refinance just yet, but we hope that when we do in the next year, that will dramatically increase the capital value, and then we'll look to extract some of the cash out of that and reinvest that into the next project.
Yeah, all the figures when we're looking at deals, we're always looking at obviously the ROI. So that's the return on investment on the money that we put in to the deal. It's not the yield, it's the return on the physical money that we put in to get it over the line. So we're always looking at the projections of that over, generally look at it over 5 years. And very specifically, what we're putting here, refinance out, is the potential refinance, potential money that we'll get out. So on this one, quite simply, there's 232,000 that went into it. Within 1 year, it's almost potentially all the money out, or within 3 years, it's the money out plus an extra 100,000. I know in this case, as an aside, I think Duncan's on a 2-year fixed mortgage, so there's probably no point in getting the money out beforehand. But at those 2 years, often we're looking at the initial lending, so it corresponds to when we'll have sufficient value to refinance, get money out and do something else. So part of this presentation is about joint ventures in commercial property and how they work. So I'm going to speak a little about this, and then we're going to look at a specific example that we have at the moment. So why joint venture? Couple of reasons. Funds needed can be higher than entry-level residential. So typically we're talking about 600,000 up to a few million. So it can be useful to pool with other people to be able to get into a larger project and get it over the line. And the other reason for joint venture is to benefit from the expertise and experience of other people. Specifically here, it's in the area of commercial property. So having on board people obviously that have experience in commercial property, such as Duncan, can enable things to go a lot faster. We've got two approaches, or there's two approaches in a commercial property joint venture. Either it can be let's say an existing group of people. So it might be 2 or 3 people that know each other. Maybe they've already co-invested in some other property, and this group is thinking, look, let's get into commercial property. And in which case let's say the joint venture investor partners group is already formed, and then obviously we're talking about what we do. This group might come to us and say, look, can you come on board with us to help us find the property, manage it, and make it profitable. And the other approach could be unrelated individuals looking to get into commercial property and start that in a joint venture, which can be either for obviously the return on investment, but it can be and some people just go in simply for the financial rewards, and other people go in both for the financial rewards and also to get the knowledge and experience of how a commercial property project works, potentially to go afterwards and do it directly themselves. And then we've got 2 main strategies when we're going into a joint venture. We've already covered the fact that generally the type of deal that we're going for is one where after a few years, we're able to refinance and get all the deposit money out. So either people are going into a joint venture with the idea of actually getting physically that money back after, for example, 3 years to be able to use on something else. And then the other approach is ongoing growth by reinvesting money out on refinance within the same group. So here we've got a joint venture where all the investor partners say, we want to put our money in there. We want to basically leave it in there, not exactly forever, but leave it in there. And each time we can refinance, we don't want to take that money back. We want to buy something else, grow the portfolio within the same SPV. Another point which is important on any property joint venture is there still needs to be a potential exit strategy for partners that come into the venture. We don't know what's going to be happening in 5 or in 10 years' time. So the way that we always structure joint ventures is that we have the possibility for people to, including ourselves, by the way, to leave every 5 years. And generally, the way that we make that possible is that after 5 years, we have enough potential refinance available. So if, let's say, one of the partners wants to leave, we can refinance the property, so obviously increase the lending. That enables us to pay back one investor who wants to leave, and then obviously the people that remain in there have a larger share of the property or the properties. And the main principles for a joint venture, so we've got what we call investor partners and expertise bringing partners. So obviously investor partners are bringing the money, and the expertise and obviously investor partners have a majority share in the joint venture partnership. And the expertise bringing partners, they're generally not bringing money, or it might be a small amount of money, but bringing expertise in the sense of managing and making sure everything is running successfully. We set up a SPV, special purpose vehicle, which is simply a limited company set up for the sole purpose of purchasing and managing one property. And within an SPV, there's always a detailed shareholders agreement that can be like a 20 or 30 page document, which is not something that we do ourselves. Obviously, we use solicitors for drawing up these agreements, generally based on ones that already exist. We're not sort of rewriting from scratch. We'll say this is the basis. We've got our head of terms, and then we pass that over to the lawyers to get that obviously into a form which sufficiently represents everyone's interests. And there's always customized articles of association for the company, which is the SPV. Won't go into a lot of details about that, but we do that because articles of association give a higher level of legal protection than what's in a shareholders agreement. These are things obviously we can go into in more detail offline for anyone who wants to know more about that. And then there's always a set of professional advisors that are named and identified, people can check out. So the people doing the legals on the company setup, shareholders agreement, the conveyancing, accountants, including on all the joint venture projects, we produce quarterly management accounts, and obviously everyone can see exactly what is happening. Is nothing opaque. And then there's proper commercial asset management. When we get on the level of commercial property, it's a lot less, obviously can be involved, but it's less do it yourself and a lot more relying on professionals and obviously optimizing things. So at the end of the day, it can be not exactly hands off, but yeah, able to do really good things and get good return on investment with not a massive amount of time. We're going to be talking about some figures for specific deals. So we're legally obliged to put the notice here that any specific deals that we're talking about are only available to investor partners who can fall within these categories, because obviously these are not regulated by the FCA. So that's a little speech about that. We're going to look at a detailed example, and this is a property that we currently have an offer accepted on, which is structured as a joint venture. So through this will be both an example for you to see how it works, and at the same time, if anyone is interested in joining us on this, obviously that's open to discussion. So I'm going to hand back to Duncan to explain about this this project, and also specifically how we deal with the potential risks, because this is offices, and we made a comment about offices. So yeah, Duncan, I think will specifically address that.
Thank you, Trevor. Yeah, so this is a great opportunity to acquire a regional office building in Wakefield, just south of Leeds, and the whole estate is owned by a fund. Bought the estate 4 or 5 years ago, and they're looking to dispose of one of the office blocks on the estate. So it's a very well kept trading office park. And the building is in great condition. It's essentially one large building split into 2 floors. So you have a ground and then you have a first floor. At the moment, both are open plan. The ground floor is occupied by a national food company, so a pretty strong tenant covenant there, who have taken a 10-year lease back in June 2023. There are rolling breaks throughout the lease, but there are quite strict break provisions. So we'd be notified in plenty of time if they were to operate that. And the opportunity here that we see is that the fact that the agent and or the vendor has priced this on a yield based on that ground floor income. The first floor is completely vacant at the moment. It has been refurbished by the landlord. It's in very good condition, but it's about 8,000 square feet on the first floor, sitting vacant on the market. So the ground floor is generating an annual rent of £95,000 a year.
Let me move on to the figures if we're talking about figures.
Sure.
Well, actually, yeah, this is, yeah, let's go on to that one, Duncan, yeah? And we'll come back to the other ones afterwards.
Yeah. And so at the moment, it's priced, the building is priced on a yield purely on that ground floor rent. So at the moment, we have a price agreed at 875,000 based on the £95,000 in rental income, leaving little to no value applied to the first floor. So our strategy here is to acquire at 875 and then look to relet that first floor as quickly as possible. Trevor, I don't know whether you want to jump in here, but
yeah, I'm going to say, how can we let the first floor, if it's a full office floor and maybe difficult to find a tenant? The sort of questions that people will be asking.
No, quite right. So it is on the market, this first floor. It has been refurbished, but requirements for a large lump of 8,000-9,000 square feet are few and far between at the moment in Wakefield. And what we're finding is, as part of our due diligence and research, is that there are a lot of requirements for smaller space by smaller occupiers. So our plan is to take this first floor and subdivide it into 3 or potentially 4 office suites, and start to target those smaller occupiers and relet the first floor on market terms, probably higher rent per square foot than the ground floor, but over the first year or two, look to relet those office suites and actually subdivide the floor on a sort of individual basis. So we would speculatively spend a bit of money as some capex to offer and present a market office suite, show some people around, generate some interest, and let that space before moving on to the next one. So you can see here there's a bit of a table in terms of some evidence on some rental transactions over the last year or so, and you can see there the sort of the general tone of rents per square foot achieved, along with the typical lease terms, 5-year, 3 to 5 year leases, and with the occasional break clauses in there, led to some sort of SMEs in terms of tenant profile.
Yeah, I think I'd add here is I was going to ask Duncan, maybe it's top secret, where he found all this information. But obviously, just like when we're dealing with residential, we're doing a detailed analysis of comparables and understanding how we can obviously maximize the income on a property. And here in reality, what we're doing is we're taking a property that is like sort of a massive floor space, and we're moving towards what we're normally doing, which is multi-unit, multi-let. So we're making it, this part into smaller units to be able to reduce the risk, and yeah, obviously increase the income. And yeah, key thing on this one is it's like sometimes we're yeah, buying when it's like a mixed use, we're buying it on the basis of the, as Duncan has already said, valued only on the ground floor, and we've got the first floor almost, in inverted commas, free. And by fully letting that, we're going to be more or less doubling the value of the property, which obviously when we get to refinance, we'll be able to get more than the original money out. If I go back to the original figures of what it costs to buy a commercial property and what we have to factor in on those costs, I'll hand back to Duncan for him to go through those in briefly.
Yep, so it's mostly there on the screen in front of you, but you know, on the market at 900, and we've negotiated a slight discount at 875. But you know, even at that level, it still looks a pretty good deal to us.
Hello. Hello, is that Vivian? This is Geeta. I'm calling from Spare Room. You wanted to, you were asked about viewings for rooms.
So this is
Are you
commercial.
Vivian by any chance? Sorry.
This is
Are you
commercial
Vivian?
property.
Oh, sorry. Then they've given.
I think you're
Sorry.
on. Sorry, let's carry on. Sorry.
Unless anyone else is renting out their spare room.
Yeah.
So yeah, you can see here that the typical loan to value that we typically adopt. You know, there is some movement on this if required, but you know, we typically fix at 70% LTV. Stamp duty is for commercial is lower than residential, and you can see there that we put in some pretty accurate sort of estimations on legal fees, conveyancing, arrangement and valuation fees based on, you know, what fees are being paid for in the market at the moment. And then Trevor, I suppose we can hand over to our sort of acquisition fee here.
Yes, that's right. Yeah, the acquisition fee is basically our fee for finding and negotiating the deal. I see someone, Aisha, you have a question?
Sorry, I'm just double checking to see if you've added, you know, the loan. Would you refinance this directly onto a mortgage, or are you using a bridge?
So this one is, and that's a good question, in fact. All the properties that we're going for in this, in what we're talking about tonight, so pure commercial property investments, we're going for properties that are already income producing. So from day one, they're mortgageable on term lending.
Got you. So you don't need to refurbish. You're just going directly onto a term mortgage.
That's correct. Yes, there's some. So in this cash flow, this 30,000, part of it is for cash flow, just bog standard cash flow, but majority of that is to start dividing the first floor. So it's not refurbishment. It's like dividing it up in order to be able to rent out smaller units. But that doesn't affect the initial lending, and we're going directly with, basically the initial lending will be based on the income from the ground floor, which gives us effectively this value of around 900,000. So we're not going to have an issue in getting 70% loan to value on that. And within a couple of years' time, when we've got the first floor fully occupied, we'll see that in a moment. Then we'll have a higher income and we'll have a higher value. And then we can go back to the lender and say, look, let's get a new valuation. Can we borrow basically more money based on the new value so that we can get money out? In this particular joint venture, we're not returning any money to the investors, because the aim here is to multiply that money, that equity, by buying an additional property within the same SPV.
Okay, so Sorry.
No, go ahead.
I was going to say, so you're buying directly onto a mortgage, and because the first floor is occupied, that gives you enough income to show the lender this is income producing.
Correct.
And then once after a year, are you able to, is that allowed after a year to break the terms of the mortgage and take money out by any chance? Is that a possibility?
Yeah, it's fine to remortgage after 1 year. Yeah,
Oh,
depending obviously on how we negotiate it, we might have early repayment fees.
Mm-hmm.
In which case we have to factor in, are we going to wait maybe 2 years, for example? We might take a 2-year fix. Are we going to wait 2 years and then do it? Or are
Gotcha.
we going to after 1 year? Generally, we probably wait for 2 years because we can prepare that remortgage in advance, maybe 3 or 4 months in advance. And at the same time, if we know that at the end of year 2, we're going to be able to refinance and get this 400,000 or maybe a bit more back out, we're going to start looking for the next property that the SPV will buy when we do that refinance.
Okay.
And it could even be the same lender that does the refinance and the finance of the second property.
Got you. Okay, so you're saying buy the property at 900k, you've got income producing on the first floor. After the end of the mortgage term, you'd have the other floors up and running. So you should be able to refinance at a higher level and take more money out within 2 years.
Yeah, and that actually is on this table here.
Okay.
So we've got the valuation here based on, obviously this is projected and no one can guarantee this, but this is based on experience, what we're expecting to achieve. So when we buy the valuation based on yields in the area, so obviously that's Duncan's speciality, is theoretically with the current income, we should be able to get a valuation of 950. In practice, the value is only going to give the value of the price at which we're paying. We know that always works like that. And then we've got the net income here is income after paying the mortgage interest. So, but obviously by the time we get in year 2, we've actually been very conservative and we've considered we've only got half of the first floor occupied, and then we're fully occupied when we get to basically the end of year 2. So based on the potential valuation, at the bottom here, we've got the potential money out with a refinance. And I'm going to add one thing here, which I think is actually quite important, is that when we refinance, because obviously here we got a higher value, but that's dependent on the income, to reduce a little the risks, we generally refinance at 60% loan to value rather than 70% loan to value. So we've got some margin in there. Does that answer your question?
Yeah, it does. Is there a reason why you go for tenanted properties? Would it do you not have more of an opportunity to add value if you were to go for something a bit more run down that needed some work doing to it, as you know, or that was
It's a
vacant?
question of risk as well. And I'm going to say this corresponds a bit more to if we can get this type of return on a property that's already income producing, I'm talking to myself, not to anyone else. I'd be stupid to not go for this. Why buy something run down, go for a bridge, planning and everything else? Maybe not so much planning, because in the commercial sphere, if we're in a zone which is zoned appropriately, is sort of just not worth it. Unless we can get something for almost nothing. The aim here is to get an immediate return on the income. Obviously, we've got here 7.8%, and that is not exactly guaranteed, but we've got a tenant in there on a strong lease. That's the money coming in. So that's what the investor return on investment should be from day one, paid every quarter. So rather than buying something that is completely dilapidated, having a lot of capital expenditure risks, blocking the money for probably 18 months, it's basically the strategy that we're adopting.
Okay, understood. Thank you.
I think
And
just
it's
to
also,
add
yeah,
over,
I say it's more nice, well, yeah, more appealing, and it's lower risk, because this type of investment, as well as being obviously people that understand property, I think a lot of people on this call are probably already doing different property projects. These type of investments also appeal to people, for example, working in the city, who are obviously accumulated some money and want to get a good return on it, and want to be sure that it's properly managed, so we see who's doing the legals, who's doing the management, and they can see immediately what the income is, what the potential income is, and go for it simply as an investment. Sometimes, again, I'm saying this because obviously we're talking to property people. Sometimes we go for properties that are already income producing on a commercial basis, and potentially we're going to they might have got a lease on there for another 2 or 3 years, but they might also have potential for conversion to residential, and there we can effectively combine both of them. So those of you that are like itching to get a property that you can break and convert into flats or something, then or also potentially get something that's got a really good commercial yield, but you might have like some risk going forward. Is that commercial tenant going to stay? If you know that you can also achieve probably a really good profit by converting to residential, and you're likely to get the planning, that's another reason potentially to go for that that type of deal. And sometimes, sorry, I'm going on quite a bit.
Can I raise a question on that note?
Yeah, go ahead. Yeah.
It's about commercial, obviously. Now, I've come across a 3-story building, somewhat 14,000 square foot, Class E, currently vacant, and potentially looking at the prospects of converting it into flats, which is what you just touched upon. Is this something that you do, you'd look at, advise?
It's something that we do. In reality, Duncan doesn't do that so much. That I've done that quite a bit. Obviously, I think there's probably quite a few people here from different groups that have done that, and I'd be happy to have a discussion offline about that type of deal and that possibility. And sometimes it's also possible to, if there's a property that is that you want to convert into residential that has got a commercial tenant in there, or that potentially you could put, because you can do long leases, you can also put commercial tenants in under license. So like, for example,
It's
for a
empty
1
and
year,
vacant at the moment.
you got the potential of, obviously we need to understand what the property is like, but if you could let it out on a short-term basis for a year, you got your commercial income, potentially you get it on a commercial term mortgage, whilst you sort out all the planning for conversion.
Yeah, I appreciate that, because I was thinking lease option or something to that effect.
Yeah, but happy to have a chat offline about that. We'll get back to the subject of the commercial. I see that Ravi has raised his hand. Maybe have a question.
That was me, that was my question.
Oh, it was, okay, great. Sorry, wasn't clear who was speaking. So coming back to the figures, so these are what the figures look like on this specific investment, and I see time is going on, so I'll be fast on this one. How does it work between what we call the investor partners and the people bringing the expertise? So what we call in this case the founder partners on this joint venture, it's Duncan and myself. Generally the founder partners are taking a share of equity. In this case it's 20%, and we're bringing expertise rather than money. And because obviously we need to demonstrate, we're obviously confident about that, demonstrate that we're going to achieve success on this. The way that the income is distributed, and I know previously people were asking questions about that, up to 8% return on investment all that money goes directly to the investor partners. So the founder partners, in this case, Duncan and myself, we don't take any income from the first 8%. So that goes to the investors. And then the income above that 8% is shared between the investors, and a part goes to Duncan and myself, which is when we look at the figures, when it says here total to investors, that is the amount that is distributed to the investor partners. And then directly below, we have what's called the investor return on investment. So that is the return on money in as a percentage for the investor partners. And that, by the way, is after corporation tax. So we've already deducted corporation tax before we get the distributable income. And obviously over time as well, from day one, the investor partners who put the money, obviously there's equity because it's a share of ownership of the property, and that equity is increasing as the value of the property is increasing. So the structure, again, this is we always set up an SPV. This particular one, it's 375,000 that's needed to get it over the line, and the minimum investment is 37. It's basically 10% of that. And this one is with the aim of leaving the money in for the long term, because we're going to, when we refinance, buy an additional property. We do from time to time do joint ventures where the aim there is to buy one single property and actually get the money back to people. So people that might have got their idea of some specific project that they want to do themselves in 2 or 3 years' time, obviously this is not going to be the right one. It would be, yeah, contacting us about another one where the aim on this one is to, on another one is to get that money out after the 2 or 3 years. And then, yeah, we've got the estimated ROI, which potentially jumps up to around between 20 and 30% once we get the second property. And in these type of deals, people get their distribution every quarter. So this is an SPV, and these are the people that deal with both the legals, the accountants, and the ongoing management. Ongoing management, La Roque Consultancy. That's Duncan's consulting company. And this is open for investors up to the end of this month. Obviously, if anyone is interested, to send me a direct message or email after the call, or if anyone's like interested in other types of joint venture, or yeah, wants help in finding a suitable commercial property that yeah, you'd be owning directly yourselves or via a SSAS, then yeah, don't hesitate to contact us. Are there any, before we go on to the next one, are there any questions about how these joint ventures work or this specific deal? Okay, so we'll move on to the, oh, there's one extra slide, investment term. So yeah, we're always generally talking about on these joint ventures, minimum of 5 years investment time. It's always possible, and we always put in the shareholders agreement that people can sell their shares to someone else at any point in time, as long as the new investor meets the same investment criteria. And it's always necessary to and it's always, sorry, just something coming up here, and it's always necessary to propose those shares to other shareholders at the same price to give them the first option in buying them. And then every 5 years, again, we've got enough time to go into detail, we have the possibility for people to be able to exit, and the value of that exit is based on an up-to-date RICS valuation. So this is a example of a property that is not a joint venture. This is simply an example of the type of property that we're able to find for people that want to get into commercial property. So I'm going to hand over to Duncan and yeah, to make a few comments about this, and also explain in yeah, 2 or 3 minutes some of the key things that are needed to look at to determine whether it's a good deal or not.
Thank you. Yes, so this is a another opportunity we have in Bradford, close to Manchester, and it is essentially a multi-let office building, very, very close to the town centre of Bradford. So a great location. It's been owned and managed by a private individual who has looked after it very, very well. It's quite a high-tech building in the sense that it's got a lift. It is listed, but it's been very carefully managed. It's got security, it's got CCTV, access control. So it's in great condition. It's fully let. We have 11 tenants here, with an annual income of just under 74,000 a year. So it's a relatively safe investment in that sense. And in terms of figures, we have negotiated a purchase price of 650,000. So it's quite a good yield on day one, with the potential to steadily increase that rental return, you know, over the short to medium term, when we have rent reviews, lease renewals, and lease reversions. So there are ample opportunities throughout every year to nudge the rent up from a variety of different tenants. So that's the attraction here. We've obviously, as you can see on the screen, we've negotiated a heavily sort of reduced purchase price after a long sort of 6-month period of negotiations. And you can see there on the screen the lending, the stamp duty, conveyancing costs. So we're looking at a total deposit essentially of 261,000, and that is essentially us running the due diligence for you, procuring the opportunity, and then handing it over to you upon completion. We are, you know, happy to discuss managing the building for you and helping in that respect. But yeah, you can generally see the figures here in front of you, and what the returns look like over the first 5 years. Trevor, I don't know whether
Okay,
you
yeah,
want to
thanks.
talk about the returns.
Yeah, and it's always the same way of presenting things. So we're looking at the potential net income. So not on this, we haven't got obviously all the detail figures here. We're looking at the actual income, and based on the yields, determining what a potential valuation would be. So here we're looking at how long it takes to be able to refinance and get all the money out. So here it's this in reality it's maybe very not really safer, but it's more traditional, sure, because it's like 11 different tenants. It's close to a city centre. So yeah, we're looking at maximum 5 years to be able to get all the money out, and return on money in is obviously quite a healthy return. And this type of property, obviously, if we're going to the last slide, is suitable for a SSAS investment. So without going into a lot of details, we only got a few minutes left. SSAS pension funds can invest directly in commercial property. As an aside, a SSAS cannot take shares in a joint venture, because a SSAS cannot invest in a unlisted company. There is a way around that, and if there's a number of people that have SSAS pensions that want to come together to buy a specific commercial property, we can help with the structuring of that. And in this case, the title the title is not split, but the title is shared between the different SSAS pension funds that invest in that property, and then typically there's a separate holding operating company that is established to look after it, to generate the income, and obviously then send that income to each of the individual SSAS funds that have invested. And the SSAS can borrow up to 50% of its net asset value. So that means if, for example, you're starting the SSAS and you haven't bought any commercial, well, any properties at all, then basically you can borrow 50% of the amount of money that you're using to buy the first property. Obviously, the lenders will typically give up to 70%, but the SSAS rules are going to limit that to 50%. So that's a really fast overview of how to use SSAS for investing directly in commercial property. So I'm going to finish speaking, and we're happy to take a bit of time and answer any questions that anyone has. No questions. Maybe some comments. Maybe some people on the call have already invested in commercial property.
Trevor?
Hi, Trevor. I have a question with the SSAS. So when can you draw it out, the money that to use the cash, like your investment, obviously your profit of your investment, when can you draw it out to use it on maybe non-commercial stuff?
Sorry, could you ask the question again? I'm not sure I fully understand the question.
So if you've bought the commercial property on a SSAS, but you wanted to eventually use the income, when can you draw it?
So the ongoing income will go directly into the SSAS and be accumulated in the SSAS, and you can then reinvest that accumulated income in something else. And in the same way as the value of the property goes up, that means that when you do the annual or whenever you do it, the net asset value, it will take into account the current RICS valuation of the commercial property, and on that basis you can potentially refinance to get money out, and that money out obviously will go back into the SSAS, and you can reinvest in something else. So in the same way as the joint venture that we've currently got live, where we're looking after 2 to 3 years to refinance and buy a second property, in this case within the SPV, if you have a SSAS that's buying a commercial property, you can accumulate both the income and get a new valuation, get new lending, obviously still only up to 50% of the net asset value of the SSAS. So basically getting all your money out to reinvest in something else.
Thank you.
Again, if anyone wants to discuss in more detail, I'm happy to have a little chat with anyone offline.
Sorry, Trevor, I just had a quick question about the figures on the other slide.
Yeah, which slide was that?
The one just before this one. So you're making an increase in profit every the value is going up every year. Is that because what's causing that? So what are you doing every year for the value to go up? Because on the other project you were developing it gradually, but whereas with this one,
we're not touching the property. We're increasing the income by permanently revising the leases and the rental income up to the market value. And as we increase the income, because it's a commercial property, the value is based on the income and the commercial yield for that area. Hence, the valuation is going to increase.
Okay, got you.
But it requires active management. So it's not a question of, in the same way you buy got a buy-to-let property, and you don't bother telling the tenant every year that we're going to increase the rent, or you don't say to the agent, deal with the rent increases, then at the end of 5 years, you haven't increased your rent. Whereas if you're actively managing it, which is why also we're sort of proposing these, and proposing obviously is possible to individually manage it. We're proposing to professionally manage them, to basically on behalf of the investors to get the maximum income and therefore the maximum potential valuations.
Okay, so you're putting your tenants on a 5-year lease, and you're going to put in that lease every year. The rent is going to go up by X amount, basically.
That's right. That's standard thing. Yes.
Yeah.
Trevor, I'll just jump in here. So
Yeah, please, yeah.
for Belmont, there are 11 tenants under 11 separate leases. They all started at different points. So you throughout every year, there may be 1 or 2 rent reviews, there may be 1 or 2 lease renewals, and at that point you can capture slight increases on the rent. So over a 5-year period, you'll have multiple opportunities to increase the rent, hence the rental income. So for Middlesbrough, for example, the example we used earlier, you know, I've got 20 odd tenants, and every year there's 2 or 3 rent reviews, and every year there's a couple of lease renewals to deal with. So generally speaking, the rental income trickles up every year.
Quite significantly by over 100k.
Well, yeah, you gotta it's a balancing act. Yeah.
By the way, I'm not going to show it here, but this, the figures that you see here are the result of probably 5 pages of Excel, which actually process the individual leases, estimate when they're ending, what we can do with them. It's not like a finger in the air, depending on which way the wind is blowing. It is proper due diligence of understanding what the leases are, what the potential are, looking at what the average rent per square foot for similar properties is in the area, and processing all those figures. And this is what we come up with. It's not a guesswork. It's obviously it's estimation, but it's based on real figures, facts and figures. And as an aside, the return on investment on money in, this includes the standard management fees, which generally are between 9 and 10% for managing the commercial property and managing all the leases. So this is the actual money basically in pocket at the after all the costs. And obviously we have detailed costings for all the any project that we're proposing, or sometimes we're doing bespoke sourcing. So investors will come and we've got one, for example, that wants this is completely different, who wants petrol stations, but that's completely different question. But some people might have a specific preference, and we'll focus on looking at the numbers, and if such things exist, then finding them.
Ask something. I've put a question in the chat box.
I'm not reading the chat box, so
Okay, right.
ask your question, please. Yeah.
Okay. Would you consider whether it's a joint venture or finding a property for? I have a tenants that I already want to put into a property. It's for SSH, which is specialized supported housing. So they've given me an exact model of what I need, which is for this.
Let's have a talk offline about that, if you don't mind, because that's not sort of related to the subject of commercial property.
Oh, okay. Thank you.
Yeah, send me a message. It's something that we I'm doing things in different areas, and here we're talking specifically about commercial, which I'm doing with Duncan.
Right. This is commercial because you get commercial leases on it. So
no, we're talking but commercial as in
style. Yeah.
Yes.
Yeah. Okay.
Are there any maybe one last question? I think everyone. Yeah.
Can I just ask? Sorry, Trevor. So the rent increase, is that every year? Then you're increasing the rent every year?
I'm going to let Duncan answer that. I know in some contracts, releases that I have, then we've got annual increase based on consumer price index, but it can be different. Maybe Duncan, you can comment on that.
Belmont, yeah, in Bradford, there are lease events every year, whether they are rent reviews or lease renewals. Yeah. So in some years there are more than others, but there is at least one each year. Yeah.
So my understanding for commercial properties is that they have very long leases on their rental. So that's why I'm a little bit quite confused about the yearly reviews.
Yeah, we have a combination of agreements at Belmont. So 1 or 2 occupiers on short-term license agreements that have
Right.
been there for
Okay.
quite some time. So they are monthly license agreements that continue to roll over. 1 or 2 are on, 1 to 3 year lease agreements, and then there's 2 that are on 5-year lease agreements. So they're actually quite short.
I see. Okay. So because there are different mixed use, I suppose, of
But
offices, that
within the
makes
lease
sense.
agreements, there can still be rent reviews and rent increases. The fact that we've got a lease that's 5 years or 10 years doesn't preclude the fact that within that lease we've got increases every year or at set periods. And that's part of when we're looking at a property, because we're focusing on properties that are already income producing. We're going through the leases, understanding what's in there and what's possible to do with them. Sometimes there'll be rent increases in the leases which the current owners haven't enforced or asked the people to pay. So
That makes
sometimes
sense. Yeah, that
sometimes there
makes
can be
sense.
immediate increase by simply applying the terms of the leases.
So in terms of management, obviously it's active management in that case then, I guess, isn't it?
Yes.
Yeah.
So how many % of that is management cost?
So generally management costs are 9 to 10% of the income, but in all the figures that we've given on the examples in this presentation, those figures are after the management costs.
Perfect. Thank you.
But yeah, it's and we'd recommend using professional. Obviously, we do that. So obviously, we're interested in managing properties and able to do that. And because we're like investors ourselves, we're really looking after we've got our investor hat on at the same time as the management hat on. But yeah, whether you find a commercial property with our help afterwards, just have it. We would recommend that you have it professionally managed. And also when you're doing lease contracts, don't do it yourself. Use legal people to draft the leases. If it's the same templates and models, it's not going to be terribly expensive, but it can save a lot of money down the line.
Brilliant. Thank you.
I think it's probably time to close, because although we could go on answering questions, we'll keep it sort of already an hour and a quarter. So yeah, everyone, yeah.
We should probably just finish by saying that the 2 opportunities that we presented this evening, we are looking to sort of finalize fundraising in the next sort of fortnight. So clearly, if it's of interest, do reach out and we can have a sort of one-on-one conversation with you, either over Zoom or in person, and walk you through the deal if it's of interest. So let us know.
Yeah, thanks, Duncan.
Okay.
Yeah, so I think most of you have my contact information. WhatsApp is a good way of getting in contact with me. Thanks for your time, and I hope that this was useful for everyone.
It was great. Thank you, guys.
All right, thanks.
Thank you so much. Thank you.
Thank you. Thanks very much.
Thanks, Trevor.
Okay, thanks, Nick. Yeah.